Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Axel Merk. Axel is the president and CIO of Merk Investments. He's the manager of the Merk Funds, which he founded in Switzerland in 1994 by pooling the investments he had been managing for his friends starting in his college days. He then relocated the firm to California in 2001 as an SEC-registered investment advisory firm, and he has a couple of very interesting funds. The one we want to talk to him most about today is his most recent one, a very unique ETF, a gold ETF, and the symbol on that is ounce, O-U-N-Z. So welcome, Axel. It's really good to have you back with us again.
Great to be with you again.
Really good to have you. And first, I want to thank you very much for inviting me to attend the opening bell ceremony at the New York Stock Exchange a few weeks back to celebrate the trading of your new gold ETF. That is, I guess the name of it, the proper name is Merk Gold Trust. Trades on the New York Exchange under the symbol OUNZ. So thanks again, Axel, for inviting me there. That was really a fun time.
Well, what made the event really special is the folks that came, including you. I mean, the ringing ceremony itself is, of course, a very nice marketing gig. But as you know, we met in the boardroom of the New York Stock Exchange that has huge history, and a lot of shakers in the gold industry were there, and that made that event very, very special.
It was very special, and I must say, though, that wife of yours who helped you ring the bell with her red dress on was also part of the appeal. You can tell her I said that. I think she's a very attractive, very attractive lady, and the two of you complement each other very nicely in business. So I just throw that out there for whatever it's worth. I really enjoyed the people that you brought with you that I hadn't met before, and it was just a great experience. So, well, let's talk a little bit about OUNZ. The other day I purchased 1,000 shares of OUNZ in my IRA. It cost me about, well, to be exact, I've got the number written down, $12,679. Now, as I understand it, that really represents, the 1,000 shares really represents about 10 ounces of gold. Is that right? Do I have it right?
Yes, that's correct. And you basically own a pro rata ownership of the gold that we own underneath. And as there are more people buying it, we put more gold into the trust. It's an exchange traded fund, and 1 ounce corresponds to approximately 1/100th of an ounce of gold.
And what I've been able to see is that as I've looked at my screen here, I look at the price of a share of OUNZ, and it's almost perfectly correlated with the spot price I see at Kitco. How do you explain there's no difference? It seems almost perfectly correlated.
That's kind of the idea. I mean, it's an exchange. We have two objectives. One is to hold gold and the option take delivery. We can talk about that in a moment. The secondary objective is to track the price of gold. And that's possible through the mechanism of the exchange-traded funds, where you have other market makers that compete to make a market. Basically, the market makers, they make a market for all kinds of gold products, and so they hedge the entire gold portfolio. So even if this product is comparatively small compared to the big ones out there, they can offer fabulous pricing. And as we've seen that there in the month or so that this fund has been trading, and the point is that you can place even large orders. And at this stage, the price has tracked the underlying price very, very closely. Given that this is a regulated industry, I can't make promises, but the way that this is set up, this should work, and it has been working. And we are very excited to have a product that's working as advertised.
Well, it's very convenient to be able to look at your share price and quickly multiply it in your head and know how many ounces of gold or what the value of it is if you know the price of gold. Okay, let's talk now about how we would take delivery. Suppose I wanted to say, okay, I'd like to get my 10 ounces of gold. Can you walk me through how I would go through that if I wanted to do that?
Yeah, sure. The easiest is to go to our website, where we walk you through our process at merkgold.com. We have a section called on taking delivery, and then specifically we also have a section, a gold calculator that walks you through it. And but the short of it is you fill in an online application, you talk to us, and we pre-approve that application. We allow, for example, home delivery of the gold, but we do have to check the address and so forth. And then when you're ready, and when we've pre-approved the application, you are transferring the shares to the trustee. It's a regular share transfer. You're submitting the shares are retired, and at that stage we're sending out the gold. Now, having said that, we, like many of the other gold trusts out there, we are holding London bars. Those are these clunky big bars that are great for institutional trading, but you probably rather have a few coins. Our minimum amount that we allow people to take delivery of is 1 ounce. Well, the way we do that is we're not going to chop off a piece of a London bar, but we're going to trade the London bar for coins.
Sure.
And one of the reasons why we're tracking the underlying price of gold is because the institutional pricing of gold is in London bars. Now, clearly a gold coin tends to trade at a premium, and so part of this process is you're going to pay us a fee to convert it into a coin.
Sure.
You can always take delivery of the London bar, but you can also request to have, a 1 ounce coin, and 1 ounce coins we can do home delivery of. London bars we have to deliver with something like Brinks, at Korea. They won't deliver to a home address, but they can deliver to a business address. The entire process with coins to deliver to home address takes a good week or so.
Okay, and how large is a London bar? How many ounces?
They are between 350 and 430 ounces. It's one of the challenges London bars have. They're standardized in that range. They also have a lower purity than your typical coin has. They have a purity of a minimum of 95% only, whereas most of the coins that most folks in the retail world these days want to have a higher purity, a triple niner, quadruple niner, and so forth. Very few coins have a lower purity. The American Gold Eagle is one of them. But all of you can, by the way, one thing I should mention, it is a tax-free exchange. You're merely taking delivery of what you already own. So it's not a tax event to take delivery of your gold. And the way you should imagine using this sort of fund is that imagine you like to buy the ETF, but a couple of years down the road, you'd rather own the coins for whatever reason. Well, with another way of holding gold to an exchange-traded product, you probably have to sell the ETF, have a tax-free event, and then buy the coin. Whereas with our product, you can just say, hey, I'd like to take delivery of what I already own, and you pay the premium for what it costs to get the coin instead of the London bar.
Oh, that's a very important distinction, too. I hadn't thought of that advantage. Yeah, very important. Well, I understand that the gold is stored with J.P. Morgan, is that right? And if that's true, I think that would probably cause some consternation in the hearts and minds of some of my gold bug friends. Is that true? Is that where it's stored with J.P. Morgan in London?
It is true, and the reason it's held there is because they can do it. We worked on this product for 4 years. We talked to everybody in the industry, to the folks in the storage industry, to Canadian banks, to the Royal Canadian Mint in Canada, to other banks. It was an amazing journey. But the short of it is that J.P. Morgan can do it. Now, clearly, as I'm aware, some folks in the blogosphere do have some issues with that. I visited the vault I think it was a week ago. On Friday, I was visiting it was 2 weeks ago by now. I visited the vault in London. That in itself was quite an experience. And so I did do a count on Gold Bar. I did write a little write-up on that. It's at merkgold.com. You can see my certification that I saw the gold there. But yes, J.P. Morgan is holding the gold. One of the things you have to keep in mind that with an exchange-traded product, you have to adhere to the standard settlement periods. So when you buy and sell shares and so forth. And some of those aspects and many other attributes were difficult, if not impossible, to implement with others. And that's why we work with J.P. Morgan.
Okay, so it all makes sense for sure. So you were at the vault, and quite an experience. I know that you had passed along to some of the people on your list that you were going to be doing that, and so tell us a little bit about that. What's it like? You actually count the bars, but you don't know the size and all that.
Well, we did weigh some bars and showed all these things when I kind of went through the process of the bar. I visited quite a few vaults. They all have different security processes. J.P. Morgan's are very comprehensive. And many of the vaults check mostly that nobody can break in. At J.P. Morgan, they also take it very seriously that nobody can take gold out of the staff. The first thing my office had said, hey, take a selfie of yourself in front of the vault, and I had the best of intentions doing it, but once I was there in the city of London, I decided that is not the best idea because you literally have billions sitting there, and taking a picture of it right exactly where it is isn't so prudent because you're inviting everybody to go and rob that place. Security precautions are obviously quite amazing there, and JP Morgan probably has the most comprehensive measures in place of all the places that I've visited over the years.
But the point is that you are able at any time virtually to go and have it audited or looked at. Is that
yes? Yes, we can. I can go myself. I can send in an independent auditor. And then at the same time, we do also have a scheduled audit that happens once a year to do a formal audit as part of the annual report. But yes, we can audit surprise. Also, we can decide to move the gold to another custodian. We also have or assign multiple custodians. So we do have all these authorities if indeed we were to lose confidence that this is the right place to hold the gold in. And so we, as part of forming the trust, we try to address as many of these issues as possible. We have a couple of guiding principles on our website that we put together in designing this product to find the best mix of what is, on the one hand, practical for an exchange-traded product, on the other hand, to try to address as many concerns as possible. And the key feature, obviously, is that you can take delivery. You can have it delivered to your home address. We can send it, by the way. You can request it anywhere in the world. And so we don't put any restrictions on where you have that gold delivered to. And so with that, I think we provide a lot of flexibility. Even if we don't think that many people will take delivery, we have a scalable product. And by the way, we have a patent on that process. We have a unique new process that is scalable. Some other gold products claim that you can take delivery. Ours works and is scalable. If 1,000 people want to take delivery, we can make it happen. That's another item why we didn't go with one of the big players in the industry, because they showed for marketing purposes they once delivered gold. But if you ask them, would you open your vault a couple of times a year or a couple of times a week? They said, no, thank you.
Oh, okay. So that's assuring. So there's no way legally that JP Morgan could lease that gold out.
No,
and if you have the ability to go in there
this gold is fully allocated. This is all held on a segregated basis.
Okay, all right.
Yes.
Well, I think those are all very important points, Axel, and I thank you for clarifying that. I think that's very good. Well, of course, we own gold for reasons because, I own gold because I honestly don't trust what James Grant calls a PhD standard. I trust the gold standard. I don't trust politicians. I know that we are creating tremendous amounts of there's dollar debasement beyond belief with trillions of dollars being created. You recently put out a piece that I thought was very interesting and very important. It was titled, "Is Your Portfolio a House of Cards?" So I'd like to start out by asking just what is your view of the U.S. economy now? I mean, I know that when I turn on CNBC and the mainstream press, they'll admit that things aren't as good as they used to be, but they're getting better and things are coming along. And don't worry, we'll pull out of this okay. We just keep doing what we're doing, printing more money, and sooner or later things are going to be all right. But what's your view of what's your overall view of the United States economy now, and maybe address the bigger economy, the global economy?
Sure. Well, first of all, by putting a label out there, is your portfolio a house of cards? There's a little bit of a pun on the TV series that refers to our dear politicians. What you have to keep in mind is in the U.S., we've based our recovery on asset price inflation. And that is great if you own assets. Except, even if you do own assets, the problem is that these things can revert very quickly. And suddenly the glass may be half empty. One of the reasons why Bernanke in particular tried to push asset price inflation at just about any cost is because when you have millions of homeowners underwater, those don't make for good consumers. So he thinks by pushing up the price level, homeowners are no longer underwater, and as such we live happily ever after. The challenge is that we cannot afford positive real interest rates. If at some point the unthinkable is going to happen, that we get economic growth, well, what do you think is going to happen to bond prices? They should plunge, making the cost of financing the deficit ever more expensive. In Japan, we see that very clearly, that with a huge debt-to-GDP ratio, in my view, it's impossible to finance the deficit. Fear not, though, we have central banks around that can keep the cost of borrowing low. The Bank of Japan is denying that they would use the printing press to finance government debt, but of course that's what they do. In Europe, Mario Draghi, the head of the European Central Bank, has said real interest rates are negative and will become more negative over time. And it's in the U.S. where we're made to believe that we have this quote-unquote exit strategy. But if you run the numbers in 10 years from now, I just don't see how we're going to come up with, depending on which numbers you look at, between $900 billion or over $1 trillion a year in additional expenses just to pay interest expense if interest rates were to go up. And the way you can do it is you can have massively higher taxes. You can cut spending dramatically. With the gridlock we have in Congress, I don't think either of those are going to be realistic. And so we're going to have the same thing as we have in Japan or in the Eurozone. We're going to have a bias towards negative real rates, and that causes all kinds of issues. And one of them is, of course, it might be beneficial to the price of gold, but it creates all kinds of other headaches as well.
Oh, for sure. Well, it was, I guess it was the Bank of England's Carney. It was just yesterday or last day or two talking about higher rates. Do you think they're about to take place? Do you think we're about to see a decline in the bond markets? And certainly some consternation. A very troubling article in today's Financial Times. The Fed fears over bond fund run. The Fed is afraid that there's going to be individuals are going to pull money out of the bond funds, and the bond funds then won't be able to sell their assets, relatively illiquid assets underneath. What are your thoughts? I mean, if we have a very weak economy, why would interest rates go up? I mean, if we're really starting to get economic growth, they can lie about the numbers if they want to a point, but if everybody's unemployed, if people are, people pretty soon don't believe the politicians, no matter how good they tell the story, right? So,
well, a couple of different topics, yes. A couple of different topics here. First of all, in some countries in the world, yes, things are looking a little different. New Zealand, by the way, is a place that has been raising rates. The Chinese are drinking plenty of milk powder milk that's produced through the dairy industry in New Zealand. The Chinese are buying lots of homes in New Zealand, so they've been raising rates. In the UK, when Carney came in, everybody thought he would be super dovish, but he's had tailwinds ever since he's come there, amongst others, is because all the Russians need to put their money somewhere, and one of the places they put it in is into London homes. It's the one place where they think their money is safe. The problem, of course, is that even if you raise rates, you're not going to be able to calm down the housing market with that. But yes, Carney is probably going to be one of the fellows who's going to try to raise rates, and in the short term, that's going to provide the sterling, in our view, some tailwinds. In the long term, the British economy does have major challenges. Now, regarding the other issue you mentioned, yes, the Federal Reserve, some folks on the Federal Reserve are concerned that if there's a run on bonds, well, because you can, in mutual funds, you can get your money back the next day, that's kind of a wrapper that might be masking some underlying challenges. And so if everybody wants to sell the mutual fund, they said, well, maybe we should put some circuit breakers in place, including a transaction fee. And I couldn't believe it when I saw it. I mean, basically you're saying that retail investors are going to get the short end of the stick, and the professionals can sell all the bonds they want. As a mutual fund manager myself, we do buy fixed income instruments, but typically money market instruments. The reason we buy them is because we want to be able to sell them. Now, if others are irresponsibly buying illiquid stuff, they're going to get bailed out again. I mean, no matter how you look at it, this just smells bad, which probably means it's the perfect thing for the government to do. But it's just amazing that these are the sort of thought processes they have. Clearly, if for whatever reason bonds sell off, be that because of growth or because of high inflation, well, you can't stop the market. And if you're going to punish one group, in particular retail investors, that's going to create a huge backlash. But fear not. I mean, regulators are going to get involved, and they're going to think of some solution that's not going to make anything better, I don't think.
Well, obviously, I've certainly not been a proponent of buying bonds, corporate or otherwise, but yet when the Fed pushes interest rates down, they force people out to look for yields, right? To find cash flow from their investments because they're not allowed to be where the market would normally take them. And so we probably have, and some people have said that we've got a bond bubble here. Would you agree with that?
I would certainly agree with that. And one of the things, I'm not going to mention any competitors' names here, but some bond funds, big ones, have had outflows. Others have had inflows. If you look at some of the big shops of bond funds that have inflows, they use so-called alternative fixed income funds or whatever they may be. And if you look at the advertisements, they now promote, they invest in MLPs, Master Limited Partnerships. And then you look a little deeper. And Master Limited Partnerships, by the way, are not liquid at all. They invest in them. It's like 1%, but they can put it out as an advertisement. And then if you look deeper, the biggest holdings are in emerging market dividend-paying stocks. Well, those might be good investments, but that's not a bond fund. And so people are lured into all kinds of exotic fixed income instruments. What we tell folks is, well, why don't you kind of look at true alternatives and our kind of our expertise is the currency markets. There you can design a portfolio that has a low correlation to other things you can do. And because, while we think it's the best thing since sliced bread, the gold market is more easily understood. We come out with a gold product. We actually try to do something about this market and provide investors with opportunities to diversify. But sure, look at these bond products, but if you do look at them, please look at their holdings. They're all hiding in plain sight.
Yeah, it's very interesting. Speaking of currencies, now you mentioned New Zealand. Is that a currency that you're bullish on for the time being, Axel?
Well, we were until early this year, and then all good things can get a little pricey, and so we got negative on the New Zealand dollar, especially versus the Australian dollar, because the Australian dollar everybody hated, New Zealand dollar everybody loved. We like to be contrarian, but what's been happening of late that in New Zealand dollars, that good news just keep coming out, and so that keeps pushing up the New Zealand dollar. So we've reduced the kind of our negative sentiment on that, and fundamentally everything is great. It's just the valuation is a little pricey. Australia, we are quite excited about, most notably because we are far more positive on China than many others are. I think China is most misunderstood, and with China not falling apart, the Australian dollar should also do quite well, and because the Australian dollar is relatively speaking much cheaper, we think there's more upside potential in the Australian dollar. Very interesting. Now, would you say that New Zealand has a less intrusive monetary policy, less regulate? I mean, is there less regulation? Is there more of a free market in New Zealand? I remember some years ago, New Zealand really came out with a more free market orientation in their economy. Is that still true of New Zealand? In general, yes. Of course, there are politics also happening. I can't go into depth on all of those things, but keep in mind, of course, the New Zealand economy is much smaller. I mean, one sheep dies and the GDP plunges in New Zealand. The Chinese are buying homes not just in California; they're also buying homes in New Zealand, and all of these things have a massive impact on the economy. Generally speaking, they allow the currency to appreciate, to put a dampener on exports, and that's a very natural way of cooling down the economy. So from that point of view, they're embracing those things much more, but politically it's very difficult. So last year they tried to quote-unquote exhaust all the macroprudential tools, as they're called, to calm the housing market. That didn't work, but they did that for political reasons, and now they're raising rates to cool the markets, and those things are working. So in the scheme of things, yes, they're far more pro-market than many other countries around the world. Your fund, mention to our listeners the name of your fund that handles the currencies. You've got a couple of different funds besides Ounce. You talked to us before about it, but tell our listeners again about your fund that handles currencies. Sure. We have three of them. Go to merkfunds.com. The one that I was mostly referring to is our Merk Absolute Return Currency Fund. We call it our currency war strategy. One of the things we believe is that as little as we like our policymakers, we think they're predictable. A lot of what we do is try to study policymakers throughout the world and allocate money by being a step ahead of them. And so our absolute return currency strategy has done just that. We also have a hard currency fund that's more of a managed basket of currencies where we diversify out of the dollar to a basket of currencies. Well, very good. I think that's some very good. How has that fund performed? The Absolute Return Fund. The Absolute Return Fund, we substantially enhanced the investment process in the summer of 2012. Since then, has done great. Great as far as what the fund should do. We're not trying to get equity type of returns, but we're looking for mid to upper single digit type of returns, and that's done that. Our hard currency fund has done, by the way, also quite well, but it's way too boring for most people because they're chasing returns in the equity markets these days. We need a good old-fashioned stock market crash, which I don't think is too far off for the hard currency strategy to again become more popular. Okay, Axel. Unfortunately, we're out of time. We go on and on with you for sure. I look forward to talking to you again sometime in the near future. Thank you very much for being with us today. My pleasure.